gross profit, operating profit, net profit. Every CA uses these terms daily, but the gaps between them are where most analytical errors hide. A business can have a healthy gross margin and still be hemorrhaging cash at the operating level. In this episode, we unpack all three profit lines precisely, what each one captures, why IAS 1 structures the statement this way, and what the movement between lines tells you about the underlying business. IAS 1. Presentation of financial statements does not mandate specific line items called gross profit or operating profit. It mandates that items be presented in a way that is relevant and reliable. In practice, paragraph 82 of IAS 1 requires revenue and cost of sales to be shown, which makes gross profit a natural subtotal. Operating profit emerges from adding or deducting all other operating income and expenses. The standard gives entities a choice between a nature of expense and a function of expense presentation, but the function format, the one that explicitly shows cost of sales, is by far the more common in listed entities and is what we use throughout this episode. Let's anchor the whole discussion to a single company. Volta Manufacturing Limited. Volta makes industrial electric motors. Revenue for the year is 12 million rand. Direct materials, direct labor, and factory overhead, the costs that attach to the product, total 7.2 million. That gives a gross profit of 4.8 million, a gross margin of exactly 40%. This 40% tells you one thing. For every rand Volta earns from selling motors, 40 cents survives after covering the cost of making them. It says nothing yet about whether the business is profitable in any broader sense. The single biggest classification error on income statements is the misallocation of costs between cost of sales and operating expenses. Factory depreciation belongs in cost of sales. It is part of the cost of the asset that produces inventory under IAS 2. Warehouse depreciation for finished goods storage is an operating expense. Sales directors' salaries are operating expenses. This distinction is not cosmetic. Misclassifying a cost inflates or deflates gross margin, and analysts comparing your margins to industry benchmarks will draw completely wrong conclusions. When you review a client's or employer's accounts, always interrogate the boundary between these two sections. Now we deduct Volta's operating expenses to arrive at operating profit. Distribution costs are 600,000. Administrative expenses are 1.4 million. There is also other operating income of 200,000 from a government grant related to training. Operating profit, often called EBIT, earnings before interest and tax, comes to 3 million rand, an operating margin of 25%. The step from gross profit to operating profit has consumed 1.8 million of that 4.8 million gross profit. That gap, 15 percentage points of margin, is the cost of running the business above the factory floor. This bar chart shows how profit shrinks as we move down the statement. Gross profit starts at 4.8 million. Operating profit drops to 3 million. Net profit, which we'll calculate in a moment, falls further to 2.1 million. The visual reinforces something that gets lost in tables. Each layer of cost is substantial and deserves its own analytical attention. A business where gross margin is stable, but operating margin is compressing, is telling you that overheads are growing faster than revenue, a very different problem from one where gross margin itself is under pressure. To get from operating profit to net profit, we pass through two non-operating items: finance costs and tax. Volta has a term loan. Interest for the year is 600,000. Income tax at a 28% effective rate on the taxable profit results in a tax charge of 300,000. Net profit after tax is therefore 2.1 million, a net margin of 17.5%. Finance costs sit below operating profit because they reflect how the business is funded, not how it operates. Two otherwise identical businesses can have very different net profits simply because one is debt-funded and the other is equity-funded, which is exactly why analysts often focus on operating profit for comparability. Let's see how these three profit lines flow through the full financial statements. Operating profit feeds through to net profit on the income statement. Net profit transfers to retained earnings within equity on the balance sheet. If dividends are paid, retained earnings are reduced accordingly. Finance costs also affect the balance sheet directly. The carrying amount of the loan is reduced by repayments, and interest payable accrues as a current liability until settled. Understanding these linkages is what separates a CA who reads the income statement from one who understands it. A word on EBITDA, because it is everywhere in practice. EBITDA, earnings before interest, tax, depreciation, and amortization, is not an IFRS line item. You will not find it in IAS 1. It is a management metric used as a proxy for operating cash flow and for leverage calculations in debt covenants. EBITDA for Volta would add back depreciation included in both cost of sales and operating expenses. The danger is that EBITDA can obscure very real costs. Depreciation exists because assets wear out and will need replacing. Always check what depreciation and amortization amounts are being added back, and never accept EBITDA as equivalent to cash generation without also reviewing the cash flow statement. Now post the key closing entries for Volta so we can see exactly how these figures land in the ledger. Revenue closes to the income summary, cost of sales closes against it to crystallize gross profit, and the operating expense accounts close in turn. The net balance, net profit of 2.1 million, closes to retained earnings. This T-account view makes it concrete. Retained earnings on the balance sheet grows by exactly the net profit figure from the income statement, assuming no dividends. Here is how to use the three margins analytically when you're reviewing financial statements. A falling gross margin signals pricing pressure or rising input costs. A production and procurement problem. A stable gross margin but falling operating margin signals overhead, cost growth or operating inefficiency. A management and cost control problem. A stable operating margin but falling net margin signals rising interest costs or an increasing tax burden. A financing or tax structure problem. Isolating which layer is compressing tells you immediately where to focus your investigation. One common exam and real-world trap: a business can be EBIT positive but cash flow negative, or net profit positive but technically insolvent. Profit is not cash. Volta's 2.1 million net profit does not mean 2.1 million arrived in the bank. Working capital movements, inventory build, slow debtors, can consume that profit entirely. IAS 7 cash flow statements exist precisely because the income statement, however well constructed, does not tell the full liquidity story. Never sign off on going concern based solely on a profitable income statement. Let's close with the key takeaways from this episode. Gross profit isolates trading performance, the economics of making and selling the product. Operating profit captures the full cost of running the business above the financing line. Net profit is the bottom line return to shareholders after all costs including funding and tax. The gaps between lines are as analytically important as the lines themselves. And IAS 1 gives you the framework, but your job as a CA is to interrogate the classifications that produce those numbers, because the integrity of every ratio and benchmark depends on them.